Okay.
So I am going to share my screen here and kind of get started in a couple of minutes. We always like to um, just not really chat, but just kind of welcome everybody onto the call before we get started here. But thank you everybody for hopping on this morning. It's a weird this call's been kind of weird. It's been really sporadic. I was just telling Ann this morning, sometimes these calls will have 100 plus people on them. Sometimes these calls will have 20, 30. Normally have 50, 60 or so on these calls. Oh, Tom's on. Good. Thanks for hopping on, Tom. Nardone actually hosting a cruise next month. I do want to mention that I've got 4 events I want to mention today from people, and we'll also let Ann talk about her events that she's got coming up today as well. But Rich Lennon is doing a really good event for small dollar IRAs. And if you guys want that information, Amelia, I'm not sure, or Adam or Aaron, I'm not sure if one of you guys could maybe search for him on Facebook and maybe find that link and maybe post that in the chat. That would be great. But Rich Lennon, he's in Richmond, Virginia, and he has a great event coming up in I think in March, if I'm not mistaken. But it's basically about small dollar IRAs. So if you got a $5,000 IRA and you want to make this thing turn into a $100,000 in 2 years or so, that's really what his whole event is focused on. And I'd highly recommend you guys go to that event. Jim Ingersoll also has a great event called Deal Maker coming up. And I'll be speaking at that event. And I highly recommend Jim Ingersoll and anything that he does. Super honest, super humble, super genuine guy. Want to put a shout out for him. And then also next month, so this will be the last month I can promote this actual event. Yeah, if we could actually get Ashish says yay Richmond. But yeah, if anybody can get these links for these and post them in the chat so other people can know about them, that'd be great. So Rich Lennon's event coming up shortly on small dollar IRAs, Jim Ingersoll's Deal Maker, and then Investor Addicts. Tom Nardone is on here. Tom, can you unmute yourself real quick and just let anybody know if there is any places still available, Tom?
Well, thank you for the opportunity to do that, Tom. I think where we're at right now is the ship is about full. Never say never. If there's a cancellation, they might be able to slide you in that spot. But right now, it looks like it's pretty full.
Right. So that's what I thought. So and then Tom does have a good event, I think, in June.
Correct. Yes, that is June. Sorry about that on the dates. 22nd, 23rd, and 24th. It's going to be in Punta Gorda, Florida. It's going to be the House Build and Mobile Home Development Mastermind. And it's going to be in the same place where it was last time, Fisherman's Village, a beautiful place to visit. It's going to be an awesome event.
Yes. So recommend Tom. Tom's been doing this for a long time. I love speaking with people that have been in real estate for multiple decades. I'm getting there. I'm probably into this 16, 18 years now. But I love talking to these old timers. And then another old timer that I just saw this morning, Leon Johnson is doing a really cool event as well coming up. And I'm not sure how many of you guys know Leon, but right now we're in this kind of part of the market cycle where creative deal structuring is like a really hot topic. I just picked up one yesterday where we're literally putting $5,000 down and we're able to take over a house subject to house that'll rent for $1,500 and we're able to take over a $500 a month payment. So you guys do the math there. Pretty good way to be able to pick up deals. So I want to welcome everybody to this call. Just thank you guys for spending some time with us today. We're going to be with Ann Kelley. Ann, just welcome to our that's not really a show, but welcome to our call. She'll be talking with us later. Just met Ann actually at the last Deal Maker and found out that we have a ton in common. Christian young lady, which I love the fact she puts her faith in the forefront of what she does. And one of her sons is actually at Pensacola Christian College, which is where my daughters are planning on going here, starting actually at the fall of next year. So excited about that. I actually have a guy who works for me, who goes to Pensacola Christian as well. And I started a new market right there in Pensacola. So a lot of things there have in common. Love the fact that she, wants to encourage people to have a purpose in their business. And that's probably the most important thing that they focus on. So love Ann, and I'm excited to have her on the call today. Let me see if here. I do want to remind everybody about the last call. We had Adrian Smoot on and talk about mobile homes, a great way to provide, affordable housing for people. These calls are recorded. They're on our YouTube page. They're also on the website as well. So if you did miss the last call, you can definitely go back and watch those last calls. So this is a new year. And I hope you guys are getting your yearly goals set out. I'm actually sitting this week all the way up until next Wednesday. I've got yearly and quarterly meetings with my different companies. I have one as soon as we get done with this call to the end of the day. Today I had one yesterday. I've got one tomorrow, one Friday, one Monday, and then my leadership team meets next Tuesday to kind of review everything from all the different meetings. So make sure you guys are doing that. If you guys need help with that, let me know. I've got a great structure and a great a program that I've helped implement in other people's businesses, but hopefully you guys are doing that. And hopefully that's good. Me since the last month. So I'm going to be honest with you, things didn't go super well for me. I got super sick on the Friday before Christmas, and it has been going on. And it's been going around, the whole country, it seems like. And I was down for almost 2 weeks, just really, really sick. Me and Kevin, actually, who's on this call, did a deal like the Friday I was getting sick, super like I'm glad I got everything done, because I'm not sure if I would have been able to get it done the following week. Got everything submitted to Quest. But I was just so sick. Two or three days, I literally felt like I was going to die. It was not cool. But also, I got to last week I spent with I think this picture here with Mary Hart and with Mr. Landlord at the Mr. Landlord retreat in Jamaica. We had a good time, and kind of one of these things where this kind of happened on accident. This is a missionary here. His name is Oral Anderson, and I was thinking to myself, I'm like, I could just get a ride from a taxi driver from the place I go to. And I could go to this resort and that'd be fine, right? Or I could see if there is a local missionary that maybe I could get to know and maybe give him, I was thinking to myself, I'll give him a couple $100 each way, which to them is probably a blessing, way more than I would have paid a taxi driver, and just kind of get to know him and just get to, maybe just, encourage him a little bit and let him know if he's ever in the States, if he's in our area. He's actually from our church and from our college and mission board. But just kind of, said, hey, so God kind of laid it on my heart to just make a quick Facebook post and let people know, hey, if anybody, and I found out about this guy, and he was looking to try to get a van to use for his church, but also be able to use it as a business to a certain degree during the week to help support the church, but also help support maybe a guy in their church and help him learn how to fish, so to speak. In reality and in the physical world here, and we got to raise $4,200 for him, and I was so surprised with some of the people that invested in that. And I believe that there's two ways you can invest your money. You can invest it for this kingdom, or you can invest it for the eternal kingdom. And I appreciate everybody who took that and helped us with it. So upcoming. So I've kind of made this, I kind of was telling Ann before this call that, I kind of not argued with God, but I felt like God was telling me to do it. And I didn't know for sure if I wanted to do it. Sometimes it's a little bit of a putting it on faith, but I kind of felt God saying, you should be doing this more. You should be a conduit for these people. So I did want to let you guys know about something that's coming up. I'm going the wrong way. Sorry. So last year, this was something I started doing last year. I went to the youth director for our church and the principal for our Christian school. And I told him, I said, every teenager should go on a mission trip. If they go on a mission trip only to just see how the people live, if they only just see how 80% of the world lives, it would be worth it for them just to kind of see how spoiled we are here in America. And just to, so I said, hey, I'll help sponsor this. I'll get other people to help sponsor this event. And last year we went to Belize, and it was so awesome because the kids did so amazing on this trip. They found out that it was the missionary's daughter's 13th birthday while we were there. And they actually did a surprise birthday party for her. And it was just such a cool thing to see the kids like pitch in and want to do things. And then there's two different groups of kids that actually went back to Belize in the summer on their own, like outside of mom and dad, outside of youth department, and just helped with Vacation Bible School or helped with events for them. And it was great to see that tangibility of how easy it is to be able to help people. So I wanted to just throw this out there. I am raising money for this year's senior trip. We're going to Costa Rica. If anybody's interested, there's no pressure. Just wanted to throw that out there. And if anybody's interested in helping some kids get to the foreign mission field and just see how it works, just get with me. So I want to remind you guys to be a conduit and not a bucket. And that's what I'm trying to be here with that. Also, want to let everybody know we do have the fund open. If you guys are interested in a loan, if you guys need a loan, or if you're interested in investing in the fund, is for accredited investors only. You guys can contact Adam and look at that great picture we've got there of Adam, everybody. So want to remind everybody about the Free for All event coming up here September 7 through 9, goodsuccess.com. And also we do have the real estate, last year's videos are available on the website for $99. We've had a couple people purchase those since the last call here. So thank you guys for that. But it's a good event. Great educators, great speakers. Next month, I think Dave even hopped on this call. So Dave is going to be our presenter on the next call. And Dave, I have done several investments with Dave myself. So when I bring people on here, this is not just somebody that, I just found somewhere. These are people I believe in. I've known Dave for many, many years and seen him speak and known him for a long time. He has a great name. And I love working with his team. So Dave's going to be on the next month's call talking about what's going on in real estate. And he's got a bunch of topics that he's going to talk about. And I'm excited about that, especially if you're an investor. I think Dave is definitely somebody you need to know. I actually got the opportunity to go and see him at his farm and at his place that he works, and got to see his kids working in his business. I mean, we're not talking like 18-year-old kids. We're talking like, I think he's 12 or something like that. Year old kid working in his business. And that was great to see. Love Dave and love everything he does for the investment community. So we're here, and I'm gonna let you have the screen here. And I gotta move some of this away so I can get rid of this here. Come on. There we go. Get out of here. There we go. I gotta stop sharing screen. And I'm going to let Ann take it away. So welcome, Ann. You've got the floor. Ann's going to share her screen, and she's got a bunch of stuff that she's going to talk about. Thanks for being on. I do appreciate you for spending time with our community today and investing in all of us.
Great. Thank you so much. It's so good to be here. My name is Anna Kelley, and I am a full-time real estate investor. I'll tell you a little bit about myself here in a few minutes, but just want to echo real quick something Tom said. Dave is a great guy. I have the pleasure and honor of knowing as well, and have done several investments with him. So I'm looking forward to hearing him speak next week. And I see Kevin on, who actually introduced me to Jim Ingersoll's group. Hey, Kevin, we live in the same area. And so it's kind of his fault that I'm here today in a roundabout way, that we have a lot of similar connections.
Your fault, Kevin.
That all share the same, faith and values. And that's what's really important to me as well, as Tom said. So I'm going to share my screen, and I've kept my presentation fairly short because I know we have a mixed group that invests in all kinds of things, but I'm going to leave plenty of time at the end for questions so that, we can maybe nerd out on more details of things going on in the economy and where I see things going, and maybe where some really great opportunities might be. So with that, I'm going to share the screen. You can put your questions in the chat, but I'm not going to look at them or take them until the end. Tom may interrupt me and ask me a few questions here and there, but most likely your questions will be covered as we go. So just put those in the chat. We'll hold off till the end, and then I'm happy to take your questions at that time.
Mm-hmm.
Okay. Can y'all see my screen?
Yes.
Okay, wonderful. So what's going on in real estate in 2023? I love the name of your group and your call, because what's going on in real estate always changes. And if we've seen anything over the last couple of years, lots and lots of changes, and more, I believe, on the horizon. So Anna Kelley, I'm known on social media as REI Mom. It's Real Estate Investor Mom. Two of my most full-time jobs. A little bit about me: I was raised in Section 8 housing, so I did not grow up knowing anything about money. I had nobody to point me in the direction of how to create wealth, how to have, basically just financial freedom. And it wasn't until I graduated college and went to work for Bank of America in their private bank department that I started getting an education as I went through financial advisory training to learn, what do wealthy people do with their money? How do they create money? And so I learned a lot at my time at Bank of America. And then I went to AIG, and AIG is a large financial institution, one of the largest in the country. And I worked in product development there, where we focused on products for ultra high net worth investors, banks, and financial institutions. And during that time, I learned a lot about investments. And I thought I was really smart at some extent. You start out in your 20s and you learn a little and you think you've got it, right? So I was on the path of retail investing, the traditional retirement model, and really didn't know anything about real estate till one of my investors laughed when we offered him almost 9% in a fixed product. And he said, honey, I make way more than that in my real estate investments. And that gave me this little spark that I need to learn a little bit more about real estate. And I bought my first real estate investment in 1998. I flipped a couple properties, and then I moved to central Pennsylvania in 2007 to help my husband start a chiropractic business. We started that business at the height of the economy in 2007 with several $100,000 in business startup debt, because we thought the economy was just going to keep going and zooming, and consultants that we hired told us the same thing. In hindsight, it was the biggest mistake we ever made, going into business with lots of debt, not understanding economic cycles and what was coming, but also ended up being the biggest blessing, because it led us to start investing more heavily in real estate. So fast forward, I built a side hustle while I worked at AIG, while I helped my husband start his chiropractic business, and while we had our 4 kids. And nights and weekends, we bought 1,900 and 1,924 unit apartment buildings, learned to put in sweat equity, learned to be landlords. We actually house hacked that 4-unit apartment building, the first one we bought. And it was a long, arduous journey. The years seemed really, really slow, the days long, but I was able to retire financially free at age 44 about 4 years ago. And now I'm full-time in real estate. I've been an author in a few books. I'm a coach and a speaker, a multifamily syndicator and developer, and an impact investor. And I'll tell you a little bit more about that as we go. So my current portfolio, I'm just showing you this to kind of let you know I have a variety of experience. I own some single family homes, luxury high-end vacation rentals are one of my favorite things to own, because my family and I travel 6 weeks a summer and spring breaks now that I'm able to do that. And we really enjoy traveling in different places. I've done about 300 million in multifamily syndications as a general partner. My syndications have been in Georgia, Texas, and North Carolina. And I'm just moving into large multifamily development, primarily focused on the Dallas, Texas market. And I'm actively pursuing larger multifamily investments with partners. With the changes in the economic cycle that we're going to talk about, I'm actually buying some things that I haven't bought in a very long time. A few single family homes, a few more vacation rentals. And while multifamily is my main thing, I have learned that in every economic cycle, there's different places that have better opportunity than other investments. And you constantly got to be watching what those things are and being willing to pivot or add something to what you do as a result. So I'm going to talk to you about understanding economic cycles and why this is really important for your long-term success as a real estate investor. Many of us can do really well when the economy is expanding and doing really well. And then suddenly, when there's a shift and the economy starts to contract, everybody starts to struggle and we wonder what's wrong with us. And the reality is different economic cycles will impact you much more than you might think they will as a real estate investor over time. And so it's important to understand what those impacts might be to ready yourself and to be able to take advantage of that opportunity. So for long-term success in real estate, really in any market, there's 3 key things that you need to do. You really need to master 3 things: finding deals, finding money, and then putting those deals together and being a really great deal maker. So one of the keys is not just finding any deals, any kind of properties, it's the right kind of properties. And for every one of you, depending on many things about you, your financial goals, your skills, what your aspirations are, how much time or money you have, you're going to go after a different kind of deal than I might go after. Everybody starts out at a different place. And that's why I'm a firm believer that real estate is amazing. There's many ways to get rich in real estate, many ways to make money, have financial security. There's many ways to lose a lot of money in real estate. So you have to get really good at knowing what's the right kind of opportunities for you, and then putting blinders on to the wrong kind of opportunities for you and where you are today. The second piece is securing the right kind of funding or the right kind of financing to take down deals, because eventually, no matter how much money we have, if we're actively investing, we're going to run out of money. So financing can really make or break a deal. It can make a mediocre deal into an amazing deal, and it can make a great property into a really poor deal. So you've got to get really good at mastering how do you secure the right kind of funding for that right kind of property. And that's basically putting it all together and becoming a really great deal maker. But the thing that I didn't understand really when I got started is the right kind of money and the right kind of property isn't necessarily enough. You have to make sure that they both are aligned with your financial goals first and foremost. But then the next thing is that they actually make sense for where we are in the market cycle and where we think we might be headed. Make sense?
Absolutely. I'm glad you brought up a couple things. Because have you ever met people that they really actually don't do super good in a good economy, but they actually do good in a bad economy? And it's kind of funny because I feel like I built my business for bad economy. And then when the economy got better, it was like, it's not getting any better for me. It's getting better for everybody else, but it's not really getting better for me. But now that we're in a bad economy almost again, I'm like, okay, I'm ready to go. And I think that's great. And the other thing that I think I've been humbled over the years with, right for you, right? Because there's so many people out there that will tell you that they know the secret sauce. They know the right deal. They know the right thing. But the problem is that other person doesn't have the skill set, or doesn't have the particular kind of funding, or doesn't have, that mindset to make it work for them. So I'm really glad that you brought that out. I think it's something that's worth hitting more, because seller finance, it's a big hot topic right now, but it's like, it's not for everybody, and it's not for every market, and it's not for every part of the country. Even there's certain parts of the country that certain things are going to work better. So I just want to hit that a little bit harder and just say, hey, make sure it's right for you. And make sure that you're constantly learning, because you're going to find parts of the market cycle where you're like, oh, wow, this is working really well. Like we had for the last 2 years, things we were doing in our business for the last 2 years, we are not doing right now, because, we had to make those shifts. So
absolutely. Yeah, we'll talk a little bit more about that and why that is, and why it is important to learn to be a full cycle investor, and learn, kind of to see what's coming, see where things are going, and then just making small pivots to say, am I really gearing up for what's ahead? Am I prepared for what's ahead? And do I understand if my business model maybe is going to start struggling, with what's coming ahead as well?
Mhm.
So the key to long-term success, and I'm just going to, hammer on this again, is to get really good at successfully marrying whatever opportunities are out in the marketplace, which are different in different cycles, to your own personal investing goals. And then once you find the right opportunities and you know what your investing goals are, you want to marry those opportunities to those goals and maximize the return that you make on that deal. And it's really important just to pinpoint here that not only dollar returns, but the time that you have in deals as well. Because in the beginning, a lot of times, if we don't have very much money, we have to invest a ton of sweat equity into our deals. I know when we started, we had no money, so it was all time. And then eventually you start making more money. But I find that a lot of times people get stuck in thinking that if a deal is going to be great, they have to save money by doing more stuff themselves. And over time, as you gain more money, your time becomes much more valuable. And so now, I look much more at return on my time than just return on my money. And so as you head into a changing economic cycle, which we're going to talk about, and some of the opportunities might be ugly deals that are going to require a lot of time. That may not be a great deal for you if your time is better spent elsewhere, even if you can make money. So just be always thinking about, where are things going? Where's their opportunity? How can I marry that to my investing goals, and also to the time that I have and the money that I have, or other people's time and money? One of my favorite things to do is to leverage other people. And so that's really important too. No matter what your niche, whether you're a flipper, a wholesaler, a short-term rental investor, a multifamily investor, it doesn't really matter. Every investor is essentially looking to buy a great deal that'll make a strong return on your money and time. And that should be your number one goal. And so if your number one goal is see opportunities, know my investing goals, know what a strong return looks like for my money or time, then it's just a matter of looking out at those opportunities and saying, what are the risks and the rewards of all of these opportunities? How does it impact my time? How does it impact my money? And one of the risks is a changing market cycle that you may or may not be prepared for. And so it's one of the key inputs to knowing, how could the return on my time or money change if markets shift? The other thing I want to just point out before we start talking about markets is not to just look at price or interest rate alone to see if a deal is a good deal. I have bought deals that I paid over asking, but I structured seller financing, or I structured an interest-only loan that allowed me to, buy a property that other people thought was worth, a 4 cap or 4% cash on cash. And I could make it a 20% cash on my own money because of the way that I structured the deal. So a good deal doesn't necessarily mean low price and low rate. If it's high price and high rate, like it still kind of is in a lot of places today, it's going to be difficult. But if you can figure out how to get a high price, but use a low rate to create a good deal, or get a low price, even if you have to pay a higher rate to get a good deal, you can create returns that help you to meet your goals. So one of the things I'm always looking to do is say, how can I make a great deal out of what everybody else sees as a mediocre deal that's still sitting on the market for some reason? Because it's not just about finding the right price. You may not get to negotiate the price with someone that really thinks they need that price. Your job is, how can I get creative? How can I get this deal done and create great returns? So when a buyer's, go ahead.
I'm sorry. Most of the time, that's going to require you to do something that most people aren't willing to do. It's great point. Me and Richard Wilson actually had a conversation about this just yesterday, about like, how do you get homes on the MLS? And I'm like, we've been getting homes on the MLS every single week since 2008. And a lot of people just aren't willing to do what it takes. And a lot of times, in order to make those returns that other people can't see, you got to be willing to do something that nobody else is willing to do.
Absolutely. And part of that is continuing to educate ourselves and to learn what other things are we not thinking about that can help us to see opportunity and create those returns. So all of you have probably heard of buyers markets and sellers markets. In real estate, we generally leave talking about real estate cycles to just, are we in a buyer's market or are we in a seller's market? And in buyers or sellers markets, they're very different. Financing varies, and buyers often give up when things get hard. I've seen more investors give up. I've had more students come to me for coaching that are just at their wits' ends, that think there's no deals out there. I can't find anything that cash flows. Interest rates are getting really hard. When you have a shift in markets, especially a shift like we're having right now, it seems hard. But when everybody else is giving up, you don't have to. And in fact, when everybody else is giving up, your competition is going away. So you have actually more opportunity when everybody else says that it's hard than you have when everybody else thinks that it's easy. So you must understand how changing markets happen and be ready to adapt. That's going to help you to have the resilience that says, aha, things are getting hard, but this means there's opportunity ahead. And it just means that if I really want it, I'm going to have to do things, to Tom's point, that other people don't want to do. So understanding how economics impacts you as an investor and lending decisions, because we're always looking for money while we're finding those deals, is really important for finding the deals that work best for you in any market cycle. And so during market cycles, some cycles, lending's going to be really tight, like it is right now. In others, like we had over the last year or two or three, getting loans is actually easier than finding deals sometimes. Sometimes there's more supply versus demand. When there's more supply versus demand, it's harder for sellers to find good buyers because, like now, a lot of buyers can't qualify for the mortgage. Credit's tight. And their mortgage payments just don't make sense for something to cash flow. And so if there's a lot of supply and not a lot of demand, prices will come down for any product. It's economics 101. And it's the opposite when there's a lot of demand and very, very little supply, which is what we saw over the last year or two since COVID, with multiple offers driving prices upward. So prices are going to rise and fall. It's part of life. We tend to be short-sighted when we look back and we think, however it looked over the last 10 years, that's how it's going to look for the next 10 years. And so we think it's only gone up, it's just going to keep it going up from here. But the reality is prices rise and fall. And if you've been investing long enough, you will see that sometimes you win and sometimes you lose. And while it's impossible to time it perfectly, and I'm more conservative, actually exited earlier, think we were going to hit a recession earlier than what we actually did. But I slept really well at night saying, what's going to happen? Where are things headed? And if you can figure it out, you buy low and you sell high. And so you've got to understand how these cycles are going to work. The other thing to know is that investors may earn either a high or low return on US Treasuries at any time, and lending rates may be different. And based upon where the US Treasury rate is and how economic cycles impact that, that can actually impact all asset values as an investor. As investors leave certain things that they see more risky, they move down the investment ladder, they take lower returns for lower risk, or if rates are really low, they're incentivized to take greater risk to generate greater returns. And so you have to kind of understand, where are we in an economic cycle and what is the opportunity cost of me investing in a certain investment or a certain niche versus pulling my money out and investing in something else altogether. And I'm sure there's going to be lots of questions on that at the end. But Tom, I think I saw your wheels turning. Did you have a question for me?
I mean, maybe you could just explain that a little bit better, like on the US Treasuries. Like, so obviously people have different options to invest. And I'm assuming that that's just, why you're making that statement, because, obviously last year you could get, was it I bonds or 9%, so.
Yes.
I mean, and
I bought some, right?
We did too. And I'm thinking to myself, what in the world? Like, I mean, if you can get bonds at 9%, what in the world? I mean, it's hard to sell a 10%, investment to somebody when you can, have buy I bonds, for 9%. So
absolutely.
Anyway,
and so I'll hit on this.
I just don't hear that mentioned a lot in the real estate world. So I'm glad that you brought that up.
Right. And that's one of the reasons I'm bringing it up, Tom, because as real estate investors, sometimes we get in this bubble where all we're thinking about is real estate, or all we're thinking about is our one niche. And what we have to realize is that, especially when you have a massive shift in an economic cycle, what happens in the interest rate world and in the treasury world really can have an impact on what investors are willing to take as a return for the risk that they take to do so. Right. And generally speaking, this is something I learned back in my institutional investing years, is that if someone can invest in a US Treasury, that's considered the risk-free rate of return, right? So if the risk-free rate of return is 2% to invest and lock your money up for 10 years in a US Treasury, if inflation's more than that, you're not going to want to park your money in a US Treasury. You're going to say, I need to move up this risk return ladder, take a little more risk to invest in something that gives me a better return. So that ladder generally looks something like this. You can get a little bit better return if you invest in municipal bonds of a state, and a little bit better if you invest in a municipal bond of a city. But there's a little more risk investing with a city than there is with a state, and a little more than investing with the federal government. Then you move up to buying bonds, and there's AAA bonds and triple B bonds, and they tend to, maybe they were paying 3% while a treasury was paying 2%. Well, investors like me are going to go, it's not good enough. I want a 10, right? A 10 cap is like over time, this great return on your properties. Well, on your investment for your properties. But if I'm going to require a 10% return and treasuries are only paying me 2%, I'm going to have to probably buy a property that's not like a turnkey brand new multifamily. That might pay me a 5% if I invest all cash. I might have to buy the 1924-plex that needs 100 grand worth of work and, you know, a year of my life in order to generate a 10% return. Well, when things shift and suddenly the US Treasury rate is paying 4 or 5, or an I bond, to your point, Tom, is paying 9, why would I accept a 6 or 7% cash on cash return to value add that deal when I can just park it risk free and make 10%? Investors are going to leave real estate to put money into that bond. They're going to leave the stock market that's very volatile to put money into that bond. And so people shift in and out of all kinds of investments based upon where that risk-free rate of return is in that US Treasury, and then where the returns are and where the volatility is as you move further up that ladder of risk in order to generate the returns that you want.
Yeah, and it seems like the only people that really take the time to get educated on this stuff is the super wealthy. And it was interesting to me when I started entering into the family office world about 5-6 years ago, and starting to see like most of them have 30 to 50% of their holdings in real estate. Like, so real estate is a big portion of their holdings,
Yes.
but that doesn't mean they're not doing oil. It doesn't mean they're not doing, you know, business, you know, ownings. It doesn't mean they're not holding gold. It doesn't mean they're not also doing, you know, a lot of these other, you know, funds and different ways to be able to, you know, kind of keep their money diversified. But to your point, like some of their money is in different risk buckets, so to speak, for their portfolio. So it's been an eye-opening experience for me. I loved it. And I've kind of start creating my own little philosophy on, you know, where I want my money sitting based on, like you said, risk versus return, and how much time am I going to have in this versus how much time am I going to have in a different type of investment.
Absolutely. It's super important. And real estate in general is right in the middle of risk and return. You know, the lowest risk is this US Treasury, and the highest risk is like certain commodities at certain times. You know, investing in all kinds of foreign new startups, business startups, commodities, things like that are considered much more risky. And so, but within real estate, there's a gamut of risk and reward as well. But the key here is to understand that you need to kind of be watching these market cycles, see when interest rates are changing, and see when the US Treasury rate is changing. And that's kind of an indicator that there might be a shift in your cycle. So let's go into the cycles a little bit more. So I want you to look at this graph and kind of sear this into your head. There are secular trends and there are cyclical trends in economics. And one of the things that a lot of people ask me is, where do you think we're heading in the economy? And if you listen to economists, you listen to pundits on financial news websites, YouTube shows, all kinds of things, people are all over the place, really highly educated, very experienced investors and economists are all over the place as to what they think about certain data points. And so you hear one data point like CPI has come down and everyone thinks, wonderful, we're over. All of this stuff is over. Rates are going back down. The economy is going to come back roaring. And other people say there's job losses, and people say the sky is falling. We're heading into a deep recession or maybe a depression, and it's never going to come back, because they're looking at little data points. They're not looking at the whole of where are we heading in the long term and what's happening in the short term. And different data points give different indicators about short-term economic health versus long-term economic health. So what I want you to understand here today is that secular trends are these longer-term trends. It says what's happening in the economy over the next 3 to 5 years. Where is all the data pointing to the trends? Are we expanding or are we contracting? If you look at the blue squiggle line here, you'll see that when it's above the red dot, the long-term trend, you're in an expansionary economy. When it's below the red trend, you're in a contractionary economy. So there's growth and contraction over and over in these cycles, these cyclical trends. And these cycles are generally short-term, 6 to 18-month trends that economists are tracking. And so when we hear data points, we need to be able to say, is this a short-term trend data point or is this a long-term trend data point? Because depending on which trends we're really looking at, we could be heading in a very different path long-term than we are short-term. So over the long term, and I don't have time to get into a lot of data on this particular call, but we can answer some questions on this. But over the long term, the United States is in a downward growth and inflation trend. And the reason for that is after the baby boomers exited the labor force, we have had significantly fewer people of working ages at each year, less and less annual growth of the labor force. And what happens is as the labor force decreases, the people at peak spending ages also decrease, which means there's less spending, which means because there's less demand and more supply, prices come down. So if you listen to economists who are talking about where's the US headed in a long term, they're going to say things like deflation or recession or flat or no growth over the next 10 years. It's hard to reconcile those with those that are saying we're about to hit a recession, but then we're going to have a V-shaped recovery and we're going to bounce back and the economy's healthy and it's going to grow, grow, grow. Over the long term, we are heading down to a very, very, very low growth environment. And the only reason that we still have some growth over 0, 1, 2% is two things. The Federal Reserve has balanced the lack of workers, the lack of labor, with producing economic growth through two things: really low long-term rates and lots of government spending and debt. If the government can get us to borrow really cheaply, we will go out and invest because we want to move up that risk reward ladder. Institutional investors, employers, people like us, real estate investors, we say it's so cheap to borrow, let's go produce, let's go create growth. And we do that. And so over the long term, I want you to understand that we are heading toward lower and lower growth, lower and lower rates to produce continued growth, and more personal, corporate, and government debt. I believe that this is likely to continue based on lots of data and economists that I listen to. But what we want to talk about now is if we understand that growth is going to be more difficult over the long term produce, it means we might have to work harder and take more risk in order to produce more growth on our own, even though the economy is growing more slowly. But over the short term, I need to try to figure out where are we in the business cycle? Are we expanding or are we contracting? And these blue circles from the time from the peak to the trough to the peak to the trough over and over again, these business cycles tend to last about 5.5 years. Since 1950, the average length of an economic cycle is 5.5 years. Now, before COVID, we had the longest expansion period, the longest from recession up in history since Abraham Lincoln was president, and that was about 11 years. So we're short-sighted and we're thinking the economy's growing long-term. It's been going up for 10 years. This is just the blip and it's going to keep going up. But the reality is this is just a longer expansion period and we're about to head back down into contraction. I think we're heading that way and I'll show you why. But this is going to happen over and over again in your life cycle. And there's arguments as to will these peak to troughs be now longer or shorter than the average of 5.5 years? Lots of more complicated things today than there were years and years ago. Lots of things that could impact where we head in the business cycle, both internal to the US, global outside of the United States, et cetera. And so we have to understand that what we've experienced over the last 10 years has been a really long expansion period. And even though it came down rapidly during COVID, the federal government stimulated the economy to get us out of it through massive government spending, putting money supply into the system, lowering debt again, and that sparked this amazing growth and recovery, even though lots of people were laid off. So the result is we've had this excess spending. Every household got checks. I had a higher income than I had ever had in my entire life, but I had so much depreciation from real estate that I was able to wipe it all out. And I looked like I made no money. And so I got stimulus checks like every month from the government that I didn't need. Well, many people did. And what did we do? We went out and we either saved it or we spent it. Most people saved a little bit, but they spent a lot. And that spending, that massive influx of money and spending into the system is what caused this amazing growth, this amazing inflation, and a rapid change in the cyclical trend from a quick depression in 2020 to a quick bounce back. Now we're dealing with the fallout of that in inflation. And I'm going to talk to you about where I think things are headed. Tom, did you have any questions for me before I move on?
No, this is just very fascinating to me. So I just love to, I'm definitely a numbers guy. So, and I love talking about cycles. So, I mean, you just keep going. I'm enjoying it.
Awesome. Okay. So along with the economic cycle, generally speaking, the real estate cycle follows the same trends. It's not always one-to-one, and there's generally a lead or a lag depending on which phase of the cycle that you're going into for real estate. So for example, I'm going to start up at the top left box, stage 2 expansion. So after you've had some pain in the economy, a recession and recovery, you start to have expansion. The federal government starts to stimulate the economy, try to get people to invest again, and they lower interest rates to incentivize builders to construct new construction, to incentivize you to refinance your properties and to take that money and go invest in new development. And so expansion usually lasts somewhere between 2.5, and the last time it lasted 10, almost 11 years, where if you bought a property at the bottom of expansion, you're going to look like a rock star when you get to the peak, because the economy is giving you everything you need to continue to grow. Cheap debt, lots of investment opportunities, and your rents are going to go up, your expenses are going to come down, your values are going to go up. And even if you bought a property and didn't do anything to it, you hold it through the peak and you're going to do really well. Well, at some point when you get to the peak of the economy, when you have things like inflation and the Fed says, we need to slow this economy down, they will start to raise rates so that you don't hit too high of a high that they chance having to raise rates so high to dip you into recession. But at the point of the real estate cycle that matches kind of the peak of the economy, we usually move into a period of hypersupply. And that means that there's an abundance of inventory. Suddenly there's way more houses than what people need. Way more apartment units were built than what people need. So construction starts to slow down, because as demand starts to pull back when the economy starts to struggle, builders and sellers can no longer name their price. Fewer and fewer buyers means that you're going to have to lower your price. Well, there's an old adage, don't catch a falling knife. So if you think you're at the peak and you're heading down toward hypersupply and heading toward recession, that might not be the best time to buy a deal that you think you're going to be able to force the appreciation and make it worth more, because the economy might be bringing the economy down to where even if you do all the right things with your investment, it might be worth a little bit less. So during the phase 3, this hypersupply, it's a great time to sell or buy a stable asset that you know is going to hold values really well through ups and downs in the economy, and to shift to buying long-term. When you're in expansion, you can do lots of flips. You can invest in short-term deals. You know that the values are just going to keep going up. When you're in hypersupply coming down, it's a really dangerous time to be trying to flip properties, because the economy is pushing against you. Moving into stage 4, moving into a recession, this is where I think we're headed. And so I want to park here for a few minutes. This is when demand for housing starts to plummet. Demand for almost anything starts to plummet. Demand for goods, demand for expendable things that are not a necessity. But with real estate, It's where we see right now. Housing recession is a leading indicator of where the economy is headed. So usually housing starts to get recessionary before a technical recession will be called for the entire country. And you see demand has plummeted. Well, why? The Fed has had to raise rates to cool down this peak and this inflation. And as they've raised rates, suddenly people can no longer close on loans that they had under contract. They're no longer qualified based on their debt ratio or based on the new loan amount for the housing prices that really didn't come down significantly yet. That's causing demand to plummet. Over 40% of houses in some markets are falling out of contract, and 30 to 40% of new home builds are falling out of contract because people simply cannot close with the rates going where they are and tightening and lending. And we're going to talk about what happens in lending with these cycles in just a second. But essentially, as demand plummets and values start to fall, lending tightens, because just like we're worried about our prices falling, lenders are worrying about the value of your home that's collateral falling. And during a recession, people start to lose jobs. There's a lot of layoffs, and a lot of times defaults soar, defaults on credit cards, on car loans, on property loans. And this is the time when you can buy properties for usually rock bottom prices. Now, again, it's not always one-to-one. And while some areas of the country, there are very motivated sellers right now, and you can pick up some great properties at low prices, other parts of the company are still resilient. They're not in this recession territory yet because the economy as a whole technically has not been called yet a recession, but this is where we're headed. And so a lot of people see this and think fear, I'm going to run away, like we talked about with the other slide. But I want you to think opportunity, because we have had such a rise in prices over the last couple of years that it's been really tough to capitalize on great deals. You had to work really hard to make them a great deal. We're going to see a lot more opportunity, a lot more hurting people, a lot more motivated sellers. And that's the time to take advantage of where we are in the cycle. But I want to make real clear that I don't mean take advantage of people, because I'm a firm believer that when you help other people, you will be blessed. Create win-wins in this situation, because this is a time when people are hurting, they're scared, they're worried, they've lost a significant amount of their 401k, which is almost 70% of investors only have a 401k. So when they're losing money in the stock market, they think the value of their home that they thought was worth so much more over the last 2 years is going to come down. They're really going to be scared. And so it's an important time to say, how can I be a good person, help people out from going bankrupt, let them move on and do what they need with their life, but also realize that this is going to be the best time for me to make a really great deal that I can create a win-win and then hold it through the recovery and back up to expansion and back up to peak. So this is when you want to think about buying deals with a long-term view. And then you'll move into recovery. And recovery is this period that usually lasts for a couple of years. A recession, the average recession is 10 months. So we think recession, the sky's falling. Oh my goodness. But the reality is most recessions only last 10 months, 10 to 18 months. And a recovery is generally 18 months to 2 years. So if you can put your goggles on and say, this is going to last a year to 2 or 3, and then values are going to come up, you can kind of gear yourself up for some volatility and, not knowing what's coming, but also realize that the opportunity to really capitalize on the bottom is fairly short when you think about how long the expansion could be. So it's a great time to be thinking about, how do I marry my financial goals and the opportunities with my skills and my risk and all of those things. And so at recovery, there's still low demand for housing because people have a psychology of recession and they're still worried for a while. You tend to have high vacancy rates in apartments and in single family houses. We have a little bit of a misnomer. Well, right now we have very high occupancy in apartments because people are forced out of homes. And so this isn't one for one, but it's kind of the usual trend. But this is the time during recovery that the Fed is going to lower rates because they want to stimulate the economy again. So if you bought a property in the recession phase and you paid a really high interest rate to you, right? Maybe 7 or 8 or 9 if you have a private loan or DSCR. in recovery, rates will fall. So that's a great time to say, I'm going to buy a property. I'm going to get a great deal on the price. I don't care that my rate's high, because when it recovers, I'm going to refinance it and pull out any equity over time. And it's a great time during recovery to be buying properties and to be refinancing. So I'm going to move to the next slide, and these three are going to kind of go together. And then I'll stop and open it up for questions before we move on. So it's important to understand that what happens with the real estate cycle correlates with what happens in the credit cycle. And so during a time of expansion, I'm going to start there again in the second column. Interest rates are relatively low because the Federal Reserve wants to continue to stimulate growth. And if you remember, we're on a long-term decline of growth. And so the Fed basically has to stimulate the economy with low rates. And so interest rates will be low. Anyone with a pulse can borrow. Literally, there's a program for you if you have a pulse during an expansion period, because credit defaults are at a bottom. Incomes are high, expenses are generally low, maybe rising a little bit. Values are going up, rents are going up. And so banks get very comfortable that because the economy is doing well, even if you're not proven, if they have to take the asset from you, they can sell it and make a profit. And so expansion is a great time to be borrowing. During a downturn, which is where I believe we are at this point, the Fed actually raises interest rates. And people think, why would you raise interest rates in a downturn? Well, they're raising rates into pushing you into a downturn because they don't want things to get overheated and expand for too long. So the Fed starts to raise rates, which slows demand, and then lending is tightened because the banks are no dummies. They watch these cycles, these economic cycles, these real estate cycles, and they say, oh my goodness, if we're heading toward a recession or even a housing recession and housing values fall, we don't want to be on the hook for 80% loan to value anymore. We're afraid that maybe their value drops 20%. So we're only going to lend you 60% or 65%. We're seeing that today. Some of my large multifamily deals where I could borrow at 80%, we're getting lending offers at 50%, 44%, 60% with multimillionaire investors who have decades of experience. And that's the best we're going to get in some situations. And that's because of what's happening with the cycle, what they think could happen with values, not because of your individual credit worthiness. So you need to be prepared that lending is tightening and credit defaults do start to rise as you head into a downturn and into recession. And you'll see that little blip below the line in that third column is pretty short before you go into repair and recovery. But recession / repair for the credit cycle is where interest rates have now peaked. Lending is really difficult. And because of that, credit defaults rise. And because people are losing jobs, they can't afford to pay their car payment, their house payment, their credit cards, et cetera. So as credit defaults rise, you start seeing credit companies pull lines of credit, banks pull lines of credit. You see lenders closing credit cards that you haven't used in a while because they don't want the risk that you're going to run up your debt to cover other expenses. And then the interest rates peak. Then you head into recovery. Once you have a deep enough recession that the Fed says, enough recession, we've killed inflation, now it's time to flatline and then recover, the Fed will halt for a while and then they will cut interest rates. And generally speaking, this isn't always, but it's usually about 6 months after a recession is declared before the Fed will cut rates again. At that time, you're recovering. Lenders are really cautious. They're not going to just give free money and turn on the spigots again. They're going to be careful. They're still going to have tighter lending criteria, maybe higher DSCR requirements, lower LTVs. And then once they see that we're well on the way into recovery, and it's usually about a year to 18 months, you'll see us rapidly getting into easing credit again, just like during an expansionary market. Okay, this is the last one. This is my favorite charts because I like graphics. I wish I could take ownership of this and say I created it. I didn't. And in full disclosure, I don't remember where I got it, but I didn't create it, but I really like it because it explains to us our emotions as an investor, as a buyer, as a seller, no matter what it is that we're investing in. So at the bottom, let's start at the left. So this is during recovery. After a recession and after things are really bad and rates are cut again, there's going to be optimism. Okay, the real estate market's coming back. I'm not going to lose my job anymore. Things are getting a little better. And then on your way up, we get excited. Man, we got low interest rates. We look like rock stars. We're creating huge equity. We're refinancing. We're pulling out that equity. We're reinvesting. We're creating wealth. This is the period where wealth is created. Then we get, the thrill of I can't lose. This is really exciting. And then euphoria. What can I buy next? At the peak of the peak, everyone wants to become a real estate investor. My 90-year-old grandmother wants to become a real estate investor. Like, it's this fear of missing out. Things are so great. I got to rush in. You see gurus selling courses like crazy. You see seminars, coming next door in your small town. At this point, when everything seems to be amazing, this is actually your point of maximum risk as a real estate investor. I want you to hear that again. This is the maximum financial risk. And the reason is because you've got so much competition pushing up prices and values so high. This is whether you're in the stock market, the Bitcoin market, the real estate market. It doesn't matter. This is investing as a whole. This is the time when you have the risk that the party stops and values fall quickly and you could lose. And so you have to get careful and start watching the signs. Once things start to correct, the Fed raised interest rates, people get a little nervous. Oh no, how bad can this be? Is it going to be a quick V-shaped recovery, or is it going to be a deep recession, or we don't know? Everybody's anxious. That's where we were about this time last year, right? Then it's denial. And I feel like we've been in denial for about 9 months. This is just a temporary setback. The economy is booming. The jobs are great. Wages are high. No big deal, right? When the Fed raises rates again next month, and maybe again in March, and you see more Amazons and Googles and Apples and Wells Fargos and Chases laying off 10, 20,000 people, then you drop to fear. And then when it keeps going and the Fed doesn't pivot and you see unemployment rise, people get into desperation. When they realize that some companies they're invested in are never coming back, you might move into panic. If you're flipping a bunch of properties and you're in this phase of the curve and you can't sell your properties, you are in massive fear and desperation and panic mode right now. So I don't want to be flipping properties at this period of time. And then you get into the point of hopelessness. I wish I never invested in real estate, because some of you might be upside down. You might be in a lot of debt. You might not know how to get out. But what you have to realize is that when everybody's at the point of hopelessness and all your friends are saying, get out of real estate. I've seen guys that have been investing for years tell me, I'm moving out of real estate and I'm going back into day trading. Like I'm shocked, right? Because they're in this hopelessness, not understanding that this is the maximum point of financial opportunity. When everybody else is afraid and running away, your competition is gone. Now you have to get resourceful and you have to say, things are going to get better. Now, what am I going to do about it? Where is there opportunity that doesn't have more risk than I'm willing to take? The thing you have to be careful of is if you're in desperation mode, but you think we're at hopelessness, and I'm telling you, I don't think we're anywhere near there yet, you might buy properties that still have 10 or 15% to drop. So it might not be a great time to buy if you don't have the risk tolerance that I can afford for that property value to drop. So I'll give you an example. I bought a short-term rental in Pensacola. My son goes to school there and I want to retire there in the winters when my daughter's grown. I bought it at the height of the market, knowing that it's a luxury vacation rental, oceanfront townhouse. It very well could come down in value over the next couple of years, but I didn't care because I locked in my rate at about 3%. I knew I wanted it long-term. And I know that even if I get to the point where there's hopelessness and despair and values fall, I'll ride it up. I've got some cash reserves to weather people not vacationing if people quit vacationing for a while. And I'm going to be okay because I'm thinking long term. But if you bought a whole bunch of short-term rentals at the top thinking it was always going to go up and now people stop vacationing, you might be feeling this panic and desperation. I want to help you out and make it a win-win and buy your property on seller financing, right? Because I understand what these cycles are. But what I want you to understand is we're not at hopelessness yet. So you've got to be careful with risk, but you've got to be optimistic and say, this is the time to be in real estate. I might find better deals over this next year to 2 years, maybe 3 years than I've seen in the last 11. And so that's exciting for me. But you have to understand this is how you're going to feel so that you can be prepared when you do feel this way and tell yourself rationally, I need to speak truth to my emotions because my emotions don't know what's coming. And after hopelessness, there's depression. And I can tell you, I've never been one to feel extreme hopelessness and depression. I've been through a lot in life and I trust the Lord and he always gets me out. But 2009 was probably one of the lowest points of my entire life. I worked for AIG. I lost about 3/4 of my 401k. And I found out I was pregnant by surprise with my third baby and my husband's business was struggling. And I was in the hopelessness and depression, but for the grace of God, I wouldn't have continued. And I had to develop the grit that said, things are going to get better. And thank the Lord they did. And I started heavily investing at this point with no money and no time. 4 kids, running my husband's business, working at AIG. And I said, I gotta go and do what no one else is willing to do. And I know if I do this now, there's reward on the other side. And it paid off. Then you move to hope. Maybe the worst is over, then relief, and then optimism. Life is good. So I'm going to pause there. Tom, I think you probably have a question or two for me, but it's really important that you understand this so that you can check yourself and you can check your sellers and you can check your buyers and you can have compassion and understand where they are and really try to come to a place of a win-win when you're down at the bottom.
I think it's important to remind ourselves that there is opportunity in any part of the market cycle. I mean, Anna just said, I bought at the maximum financial risk. I knew it was, but interest rates were so low that it made sense if I'm going to cash flow this and this is going to be a long-term deal for me. I'm not looking at this in the next 3 to 5 years. I'm looking at this and how is this going to be for me and my family for the next 20 years? So I think that's great. That's a great way to look at this. But I'm really interested, Anna, because this call is kind of like what's going on in real estate right now. And you're kind of showing us the economics and the kind of the other side of everything rather than just like the houses and just what people are doing. So it's great. But where do you think we are then right now? So like with this chart, the chart before and the chart before, and obviously real estate's gotten very localized. So, where we're at in Northwest Indiana may be completely different than where we're at in Florida. And I have a market in Pensacola, so I can feel a difference in my market there than I can feel here. But honestly, 6 months ago, I was saying, hey, like things are dropping. We're getting deals today we didn't get a year ago. We're paying 50% what we were paying for our, distressed properties today than we were paying in 2021. And nobody kind of really they were all in denial. Everybody was really like, oh no, the supply and the demand, will outweigh everything. But now I think, reality's starting to set in. We're seeing markets out west that are kind of in panic mode, at least. They may not be hopeless, but like you're seeing markets out west, Arizona, Las Vegas, like you're seeing new construction homes going for like half what they were selling for a year ago.
Yeah. And I just bought a new construction home for the first time in years, right? I think we're at about the fear point. So if you look at this chart, we're not at the bottom. I think fear has set in. Look at the markets. Look at Bitcoin, look at stocks, look at bonds. I mean, we're in full out fear mode. And in some economies, desperation. And we're going to talk about how do you invest for a recession? Because we're almost there. If we're not in a recession now, it's not going to be called till 6 months after we're technically in a recession. Doesn't really matter if you're technically in it or not. We know that we're heading there. And some areas of the economy are already recessionary. Some regions of the country, to your point, Tom, are already recessionary, where other areas are still really resilient. So you have to understand where is the economic cycle as a whole nationally, but then real estate is always very hyper-local. How is this going to impact me? How strong is my local economy where I live and where I invest? How strong is it to weather any of this? How much opportunity will there be? We might not have as much opportunity in certain parts of the market. A lot of it depends on supply and demand, kind of that peak to trough. And to that point, Tom, I live in the Hershey, Pennsylvania area. And I invest here, but I also invest in the Dallas, Texas, and Houston, Texas areas. I'm from Texas originally. There is so much demand and so many people moving in those markets, and there is a housing shortage. And so you can name your price for rents. You can name your price for the property. And so they're much more resilient. They're not coming down as much. I've got to think about opportunity different there than I do, maybe in a smaller town. So let's go into that real quick. So let's talk about where we're heading today in 2023. Now that you kind of understand the high level, where do I think we're heading? These things all can impact how long and how deep we head into a trough or a recessionary type of environment. And so I'm not going to, I've learned enough to know that the smarter you think you are, the more you have to learn. And there's many things that we don't know and many things that are much more complex today that could impact how deep and how long and how wide a recession might be. But I do think we're heading toward some deglobalization, where we were headed toward globalization before. We're starting to see, because of the threats with China potentially going after Taiwan, Russia and Ukraine, shutting off gas and oil and fertilizer and food to many nations. Now, globalization is being looked at as a national security risk much more closely. And many countries, including the US, are saying, let's bring things back on our soil. So we're having a semiconductor and chips are coming back to the United States, talks of energy investment, and some things that are going to initially cost a lot of money for research and development that could cause some inflation in food and energy, for example. So even if inflation is coming down, and it is in core goods, inflation is made up of 4 components. And this is really important for you to understand as well. It's made up of core goods, the things that people buy, our stuff, the discretionary stuff. Core services, what do we want? We want to go out to eat. We want to go see a chiropractor. We want to go on vacation. Then there's food and energy. And the 4 of those make up core inflation. Well, inflation for core goods is drastically falling. As the Fed is raising rates, people are nervous. We're spending less on stuff, and core goods, it's coming down pretty well. Energy inflation's coming down a little bit, but I wouldn't be surprised if it goes back up again because of this deglobalization of energy, and if the war continues to last. And then you've got food, and food inflation is about flat. It's elevated, but it's about flat because so much is based on fertilizer and not being able to get that. And elevated energy costs causes food prices to go up as well. So food and energy prices are kind of sticky, but coming down a tad. But the last piece is core services. And when you hear the economy's strong, we're still shopping. It's true. Core services are generally elevated while people are making really good wages. So we have a lot of money, so we're still eating out because we still feel pretty good in some markets. So the Fed is targeting wages because as wages fall, people quit spending money on core services. And so until the Fed can get interest rates to kill inflation in core services, bring down wages, bring down employment enough, which means put us in a recession where there's layoffs and wages come down, then inflation will not fall enough in core services that they're targeting. So watch employment and watch wages. And as those start to come down, then you can get excited that you see CPI coming down. If it's just more coming down from core goods, inflation can last a while. But once inflation gets back to the Fed's target of 2 or 3%, then they may pivot and lower rates again. By then, we'll be on the other side of recession. Until then, I believe the Fed's going to continue to raise interest rates in February and maybe in March, and then they're going to hold it into a restrictive range. Elevated inflation, elevated interest rates compared to where we've been. And as they hold, they're going to see in 6 or 9 months from the time that they hold, are wages coming down enough? Are enough people losing their jobs that inflation is starting to come down in the range of 2 or 3%? I think that all of 2023 is going to be elevated wages. I do not elevated interest rates until they get wages and unemployment to go in the direction that they want, and until we're in a recession. And at that point, I think we're into 2024. Now, lots of things could break. We have a $4 trillion derivatives market that could break. We have credit markets that rely on cheap debt. We could have credit defaults. We can have nations default on debt. If there's something that breaks, the Fed will pivot and they'll live with higher inflation for a while. So that's why it's very difficult to say how long and how deep is this recession going to be. We don't know. But I think that 2023 is going to be recessionary, and I don't think it's going to bounce back to growth or recovery yet until after a recession is declared and the Fed pivots. Then we're on our way to recovery. So from now until then, we are in recessionary environment characteristics, whether it's declared or not. And this is going to depend on where you are as to how bad you feel it. So one of the things that happened in COVID, and it's still happening, is that major corporations are moving. They're leaving expensive cities, they're leaving liberal cities, and they're being incentivized to go to areas like Raleigh, North Carolina, Dallas, Texas, Houston, Texas. I am shifting, and I have been for a couple of years, but I'm going like 80% moving my investments to those markets because I was very, very heavy in central Pennsylvania. I still own 300 units here, but I'm buying more and more properties in those areas because it's where the jobs go. And where do people go? People go where the jobs go. So those markets are still booming. Universal Studios just announced they're building in Frisco. Well, why? Because they're not looking at the next 6 months or a year. They're looking at 2 years, 3 years, 4 years out. So you've got to look at the fact that where you're investing could make a recession deeper and worse for you. It could cause housing prices to fall much more in your area, which is great if you want to buy more, not so great if you have property that you depend on those equities. But people in general and jobs are moving south. And so you want to be in big cities where the jobs are coming, or in the suburbs of those big cities that are most recession resilient. Over the next year, because of interest rates, I see construction continue to be stalled or slowed. Housing unaffordability, as long as rates are high, even if people can get a discount on a property, they're probably still fairly unaffordable for many. I believe that the housing market will further decline nationally. But again, there's still multiple offer situations in Hershey, Pennsylvania, and prices really are not dropping very much because it all comes down to supply and demand. And so because you can't control where we are and how long we're in a recession, if you don't know the supply and the demand of housing in your markets, whatever it is that you provide, whether that's a single family house or mobile home parks or apartments, you better learn real quick because supply and demand will make or break you. And if you're providing something that's in high demand and there's not a lot of supply, you're going to do really well. My area in Hershey, Pennsylvania, it's a great benefit to have, but I have 300 units, myself and two partners. We name our rent. We are the rent leading indicator because there's no supply. So we offer more units than anybody else in my area. If my insurance goes up, I raise the rents. If I raise the rents, everyone else follows. So I want to be in markets like this where there's very limited supply, a lot of demand. It's going to make me much more resilient. And I want to buy more of these properties, especially if I can get sellers to sell them to me on seller financing right now and then refinance them later. But across the country, in areas that don't have super strong demand and a lack of supply, rents are going to stabilize and your rents could even come down a little bit. Tighter lending. I think lending is not done being tightened. In some sectors, lenders are trying to get creative and get a little looser, like no prepayment penalties, because they know we don't want to be stuck at 9% for 3 or 5 years. But other lenders are going to get tighter. And there's opportunity for growth in certain markets where there is a lack of supply, where there is a lot of jobs coming, and there's definitely regional variability. So that's at a high level where I think we're headed. I'm going to move on to the next slide to show you why I believe that 2023 is a recessionary year for us. There are 3 main things that I'm just going to touch on at a high level that show us whether we're heading into a recession. The National Bureau of Economic Research, the NBER, is who determines whether we're technically in a recession. And it's usually with a 6-month lag. But what I want to know is, what is the Fed looking at to determine whether they think we're in a recession? Because when I know they think we're in a recession, I know that we're closer to a pivot than what we have now. So there's 3 main ways that people look at economic data, that economists study. They look at coincident indicators, long leading indicators and short leading indicators. A leading indicator is something that starts to point to a recession coming before the recession is actually here. A lagging indicator means you might be in a recession before the indicator catches up to being recessionary. And so there's three kind of key components here. The longer leading indicators are, what is the Fed doing with monetary policy? If the Fed starts to raise rates, they think we're at the peak and they want to cool it off. So that's an indicator that they're going to raise rates, they're going to slow down the economy and maybe put us into a recession. The yield curve is actually the most accurate predictor of a recession of any other economic indicator out there. And it's been flashing for a year or more. I got to go back and look at the date. We're heading to a recession. We're heading into a recession. So these things are telling us housing is a leading indicator. Housing is already falling in value, falling in transactions in many areas. So those things, those longer leading indicators all say we're in a recession. So if you look at this first line, the blue is the expansion, red is recession. We're deep into recession territory when it comes to longer leading indicators. Then the middle line is the shorter leading indicator. And you'll see we're just below recessionary territory when you look at manufacturing and trucking and labor. This is not employment necessarily, but it's labor force participation, which is slowing, and it's certain labors in certain industries. So if you look at the shorter leading indicators, they're pointing that we're in a recession as well. So the third one is what I'm going to call coincident indicators. And coincident indicators, there's an economist I follow named Eric Basmajian, very smart guy. And he pulls together the 6 indicators that the NBER looks at to declare a recession. And he has an index that shows where are they at the same time, coincident to one another. It's employment, payroll, non-farm employment, retail and wholesale sales, industrial production, and personal consumption. Of all of them, 4 are in recessionary territory. The only 2 that are not in recessionary territory is the unemployment rate. It's still low, and wages. Wages are still elevated. And that is why the Fed is targeting trying to bring employment down and wages down. They want a soft landing, which means they just tip the recession line and then they bounce us back out and we don't go into a deep recession. That's this V recovery. So what the Fed wants and what the stock market's hopeful for is that we hit the line and we bounce back and we're back up into expansion without ever completing that cycle going into recession. But the reality is the Fed has said, if you listen to Powell speak, he speaks more clearly than most Fed presidents. Lots of times Fed governors, they speak in Fed speak. They say a lot of things, but it's just not clear. So when he says, we will raise rates for some time and hold them for some time, and there will be some pain for some time. That's Fed speak. He doesn't know. He said, I don't know if we'll hit a recession and I don't know how long it will last because there's so many indicators, but their job is to keep rates high enough to bring wages down, to kill that core services inflation and to get our inflation back down. Right. They're going to continue to do that. I believe that it's going to put us into a recession because every other economic indicator is already in recessionary territory. So what does this mean? You follow these charts, you see where we don't have pain yet, but remember, this is a short-term business cycle. So even if we hit recession, and I believe that we will, it's not likely to last beyond 2023 before we start to have some semblance of a recovery. Okay. Any questions for me there, Tom? Just about done.
Okay. So I don't know if you're going to get to this or not, but the biggest purpose of this call for me, it was to kind of share with my community what are really super smart people doing. So now, like, because everybody, you've done probably you've done a marvelous job of explaining this, and it's been one of the best calls we've had from that perspective for sure. But like, what people really want to know is, okay, this is great. We know it's different. We know the economy is different. We know housing is different. Our business has changed in the last year drastically. But what are you doing to either hedge, take advantage, shift your business model? What are you doing in your specific niches? You talked a lot about multifamily and vacation rentals. What are you doing differently now? Are you sitting on the sidelines? Are you looking at things a little different? How are you changing your business?
Absolutely. So one of the things I started shifting a little over a year ago. So I was early. It's taken longer to hit recession than I thought it would, to be honest with you. I sold half of my own personal portfolio. So my personal portfolio that I don't own with any other investors was about $28 million. And I sold $14 million worth of property over the last year and a half because I thought we're heading into a recession. And I knew that a lot of those properties that I bought in 09 that were the 1900 and 1920 sweat equity buildings, they were getting harder to insure. They were going to have more problems over the next several years, and I didn't want to have to put more money into them. And I knew I may not be at the top, but I'm going to maximize my value by selling high, and I'm going to get liquid, and I'm going to hold on to money, even though everybody's saying cash is trash. We're in inflation, right? You have to mitigate risk and say, how long will inflation last versus what if I don't sell now? I could lose all this equity. It's just on paper, because if we come down and we're in an area that's not great for jobs and employment and continued growth, then I want to sell those properties at the top. So I sold a lot of properties. I've never been a net seller. I've always said I'll never sell these properties, but I sold because I knew what was coming. I wanted to get liquid because I had a lot of variable debt, Tom. If you had variable debt and you have to refinance that debt over the next year, your debt coverage ratio may not meet the lender requirement. You may have to pay down your mortgages, right? I needed enough liquidity to pay down some of my mortgages so that I wasn't stuck not being able to pay the mortgage and have my properties taken. And I got liquid in order to be able to say, when there's an opportunity and that we hit the bottom and they're not there yet, I'm going to have more cash than I've ever had so that I can take advantage of that opportunity. So that's the big thing I did is I started to watch and say, this is the time to sell. And now I'm saying, over the last year, I've been very patient. It's been really tough because I'm a go-getter. I have goals. I have plans. I'm doing deals all the time. And I'm like, man, not good enough, not good enough, not good enough. I don't say yes to okay deals. I only say yes to incredible deals that I know can mitigate the downside, that are recession resilient. So I'm a recession resilient investor. And I have a slide here I'm going to show you how you invest in recession resilient things. I'm buying things now. I shifted from doing lots of big multifamily, Tom. So multifamily does amazingly well in an upward expanding economy. Value add deals where I buy a property, I gut it, I fix it up, I raise the rents, I raise the value, I make millions of dollars. That works really well in an expansion. But once you've hit the top, number one, I have variable rate debt, right? But also, when the Fed started raising interest rates, that raised the US Treasury rate. And so as the US Treasury rate now provides, let's say, a 4 cap, a 4% return on your cash, Class A multifamily were selling at a 3 and a 4 cap, at 3 or 4% on their cash. Well, now if I can get 4 parking it in a treasury or 9 in an I bond, if I could have put it all in an I bond, I would have, but they limit you to $10,000 a year. But I bought $10,000 per family member of I bonds and told my parents to do the same thing, right? So I put a little bit of money there. But what happens is as that treasury rate goes up, there's a risk premium everyone demands for moving up that ladder, which means that people are taking more risk now to buy a multifamily. They're going to want a higher return than what I'm able to get based on the prices and the debt I'm able to get. So I'm not doing very many value add deals, only incredible value add deals where I'm buying the property. The last one we did was $60,000 a unit below the last sales comp. We bought it at a great basis. And we said, we might have to hold this 5 years instead of 2 or 3 because we know what's coming. So we've shifted a little more toward development, Tom, because there's still areas like where I'm investing in Dallas, Texas, where jobs are coming. Huge companies have announced warehouses. They're breaking ground. And guess what? They're 45 minutes out of town and there's no housing. So we're developing apartments there, knowing that we don't need rents over the next 2 years when it's painful. By the time we're going to sell and fill it up, we're on the other side of recession. So that's some of the things that I've done. And I'm buying short-term rentals. I'm looking for a bunch of nice luxury short-term rentals that I can afford to cover the payment if people don't vacation over the next year or so, or I can create win-win deals with seller financing.
It's interesting. I knew me and you thought a lot alike. And this is what I was telling all of my investors to do all through 2020 and all through 2021. You're saying you sold too late. I think you sold the exact perfect peak time of the whole market cycle. But so like that's similar to what I've been doing. I didn't have quite the equity that you have, but selling in the last 2 years, getting very cash strong now, because during a downturn, it's not like necessarily your debt that makes you go under. It's the ability to repay that makes you go under.
Right.
So
And if you have short-term loans, especially like on these multifamily properties, because I'm mostly a commercial investor, I have to refinance them. And now where I was able to buy them with 75 or 80% leverage, now to refi, they don't want to give me more than 65% of a declining value at an elevated interest rate. So my mortgage payment might double. It could even triple. Well, my investors still want to be paid. So a lot of people might have to have a capital call. They might not be able to refinance. And that's when you have to look at these cycles and say, what's the risk that my values could come down, that credit could tighten, and what do I do about it? And my solution was, I have way more risk based on the types of debt that I have and the types of value add properties. Those I need to get rid of. There were nights, Tom, for weeks that I didn't sleep well, that I thought, why did I sell the property? The best thing you ever do is you hold your properties and you never, ever, ever sell. But I knew that my risk tolerance, after having gone through 09 and having nothing and digging for 10 years to create financial stability, I wasn't willing to go back there again. So I said, I'd rather take the cash, have inflation eat a little bit, and sleep well at night, knowing that we're still financially free. We still have plenty of income coming in from the ones we held, that I'll never regret selling them, because I knew I sold them at the right time.
Right.
But there are nights when I'm like, man, I should have kept that one, because now there's no opportunity, right? For the last few months. But you just have to shift. And at this time, you want to buy recession resilient and investment. So I'm going to skip these two quick properties. Seller finance is really important too. We don't have time to go into that, extensively, but you've got people who, I believe over 80% of mortgages right now are under 4%. So in 2009, you had a lot of people in increasing variable rate debt. So there was a lot of defaults. A lot of mortgages are not going to default because people can't afford to buy a downsized home, smaller with a higher interest rate, but they might have to move because they have a job transfer or something. So I want to take advantage of that low mortgage rate if I can figure out a good, proper, ethical, legal way to do seller financing, and look to try to help people through win-win through seller financing. The most important thing is where you invest, though. The class A to B market, meaning strong jobs, resilient economy, great schools, good wages, and low crime. Before I underwrite any deal, and I don't care if it's a long-term rental, short-term rental, single house apartment, I don't even look at the numbers until I do a demographics underwriting. I'm going to go to greatschools.org. I'm going to go to crime grades. I'm going to go to Neighborhood Scout. I'm going to look at the crimes in the schools. If the schools aren't at least a 6, 7, and 8, and the crime isn't at least a B, I don't buy. And not heading into a recession, because the people that are going to struggle are the working class people. And if they are going to struggle, they're going to prioritize keeping their kids in housing that's in good schools with low crime. And so buying where you buy is more important than the asset class that you buy. So yes, I'm saying I'm buying short term, I'm buying singles, I'm buying multi, I'm developing multi. I've invested with Dave. Plug for Dave. Maybe it's a preview of next week, but I've invested in a self-storage fund, in a clean energy fund, in ATMs, in a gas fund. Why? Because I'm diversifying my money. When you're heading into a recession, you want to be diversified. You don't want to own, 10 single family homes in Podunk, Kentucky, 20 minutes away from the closest jobs, and there's only 2 employers. If that's you, you're going to struggle. I have my money spread around in different asset classes. So for the first time I'm out of real estate, I'm investing, because I had all that liquidity, in tax preferred investments that are not real estate, but that are also things people need. So I want to invest in what people needs, not in discretionary stuff. That's key for this point. For me, the thing that people need the most is energy, which I don't provide, food, which I don't provide, transportation, which I don't provide, and housing. So I'm all in and more in housing, but spread across different areas, investing with the tax at the forefront, because when you sell a lot, you have a big tax problem. Based upon the taxation of the things that I've bought, I'm not going to pay anything in income tax for the 4th year in a row, despite having millions of dollars in gains because of investing in these alternative investments. So the tax piece is big. But don't buy anything that you think you can bank on appreciation in the next year or two. Unless you can force the appreciation with these value add deals or Berg type of deals, buy for cash flow, buy for low interest rate if you can get the seller financing. Make sure that you have cash reserves. This is super important. I robbed Peter to pay Paul, robbed every credit card of a balance transfer that I could to buy properties and fix them up in 2009, but I had nothing to lose. But it was a little risky. Now I have more reserves than I've ever had. So if you're worried about your job, you better hold 6 months of expenses before you go buy a fixer-upper property that's going to need a lot of work. And you need some dry powder. Maybe think about, are there properties that you still could sell for a good price based on where you are, that you might have to put a bunch of money into the next couple of years? Maybe you sell them now, you get that equity, and then you have some dry powder or money to go buy. And then I buy only with a long-term view right now. I wouldn't flip a property if you paid me to do it, probably. So I'm not going to buy properties personally that need a certain value in the short term. I'm only looking long-term. And this is really important too, regardless of where you are politically, I don't care. But when you invest, if you're investing in housing, you better be investing in landlord-friendly, low-crime, politically conservative areas. Your rents are going to be better. Your tenants are going to be better. Your taxes are going to be better. And you're going to do better. And then the last 2 things is buy properties with multiple hold and exit strategies. You've got to get creative. My long-term rental, my short-term rentals that are, in vacation, I've got vacation rentals in Tennessee and Maryland and Pennsylvania and Florida. If I can't get them booked as a short-term rental, I might put a midterm rental in there. I might turn it into corporate housing for nurses. I might turn it into a long-term rental. Whatever you have to do to your portfolio, you say, how can I maximize the income that I'm getting? Where might my income struggle, and how can I pivot? And maybe you have a property you were going to flip, and instead of putting in top dollar and hoping for the best, maybe just lightly renovate it, put a tenant in it, hold it for a couple of years, and then when the economy comes back, then you value add it and sell it. And then I'm a deal maker. I'm not looking at one asset class. I'm going, where's their opportunity? Where do I have money? What kind of return can I make on this opportunity versus this one? And now how can I structure the price, the financing, and how I hold that property in such a way to still get the kind of returns that I'm looking for, which for me I still want 15% returns on my money. So I'm not buying anything that I can't hit my returns, but I'm open to just about anything in really strong areas.
Yeah, so I love it. We are running out of time, and this is probably one of the longest we've had. But just real quick before we go, if somebody wants to get a hold of you, I know you've got other things that you offer. I think you might even be having an event coming up, but can you just share with people how they can get a hold of you, and maybe if you have an event or something else that you can offer people, a podcast or whatever else you have to offer people, please just let us know.
Sure. Yeah. So I offer one-on-one coaching. I did have a mastermind, but I've put that on hold for this year just because I am traveling a lot and have some things going on with my family's health that I need to be there for. But I do coach one-on-one. So if you're interested in individualized coaching where I can help you figure out a plan for where you are, where you want to be, and how real estate might be able to get you there, really customized to you, you can find me on my website there at reimom.com. If you're an accredited investor and you're looking for passive investing opportunities in multifamily development, you can find information about me there on greaterpurposecapital.com. Awesome. And I don't have any big events coming up. I'm really limiting my travel this year just because of my kiddos and how busy they are and some health things with them. I'm speaking at a few events later in the year, but just follow me on Greater Purpose Capital or REI Mom, social media, Anna Kelley, REI Mom, and you can kind of keep up with me there.
Awesome. Well, thank you so much, Anna, for investing in our community today. I need to hop off because I got to get on a quarterly meeting with one of my companies here. It was a really great call. Please, if anybody's out there and thought that this was a great call, please let your friends and family know about our calls. The next call is going to be right here with Dave Zook. His name got mentioned many times during this call. Anna, I didn't know Anna was invested with him as well, but so I'm invested with him. Other people that I know that are on this call invested with him. And he's going to talk a lot about those investments in the car wash fund, in the ATMs. And again, like I think people think that sometimes 1031 exchange is the only option to be able to, mitigate taxes. There are other options for you to be able to mitigate taxes. And that's one of the things that I think Dave has done a tremendous job on. So I'm excited about having him, another man of faith. And I love having, that as part of my community. So it's going to be February 14th at 10 a.m. And then I actually, talking about creative financing, actually, when we were on this call, if you guys want to look in the chat, we put a lot of the different meetings that are coming up. We put the one for Ring with Rich Lennon and the Deal Maker. And I put an event for Leon Johnson, who's going to be our March call. I don't have the actual date. If it's going to be March 1st or March 7th. It'll be either a Wednesday or a Tuesday morning. But that's all he's done. He's done that for 30, 40 years, is creative financing. So, and this is the part of this market cycle where, trust me, you want to get in on some of those subject to deals and some of those creative financing deals, solar finance deals that you can be a part of. So that's going to do it for me today, guys. Thank you again, Anna. Thanks for everybody else for being on. Amazing, wonderful call. This call will be on the website, and we'll probably email this out to everybody as well in the next week or so. God bless. Work to have to give. Be a conduit, not a bucket. Love you guys. Have a good day.
Thanks, Tom.
Thanks, guys.
Bye.
Bye.
Thank
That
you.
was great.
Yes.
Thank you, Anna.
Great call.
Thank
Loved it.
you.